Hello and welcome to our session on financial modeling. My name is Jawad Ahmed Fareed and I will be your guide today on this interesting topic. Our agenda for today's session is fairly simple. We start off with a quick overview, then talk about basic design principles when it comes to financial modeling. We follow this by reviewing the three primary cases we will work with in this course and then jump straight into an extensive model building session in Excel. Let's start with the reason why we build financial models. If I look at the last 20 years of my professional life, I'd say the primary reason, the primary usage that I've put models to is the pricing question, the how much is it worth question, the valuation question. Given a set of financial securities, the question I want to ask is how much is it worth? Now, as part of our basic coursework in finance, the approach that we use most commonly is known as the discounted cash flow or the DCF approach. The DCF approach is a very simple, very fundamental approach that simply looks at plotting or forecasting or documenting the cash flows associated with an investment and then simply figuring out the net present value or the present value or the time value of money with respect to each single cash flow, and then it simply sums it up. While this is one end, on the other end, a much more interesting end is the option pricing relationship, where we go out and use the Black-Scholes equations to determine how much is a financial security worth where the cash flows are uncertain. We will use in specifically in the pricing domain, we will use a middle of the road approach and actually calculate the value of a cross-currency swap. A CCS model or a cross-currency swap model is a fairly detailed model. While we'll not completely review the entire process, we will look at the inputs that are used, and we will, once given those inputs, we will try and see what we need to do to calculate the value of a cross-currency swap under a certain set of conditions. So that's usage number one. Usage number one is the pricing question, the valuation question, the how much is it worth question. Usage number two, again in the same professional life, was the investment question. Now the investment question is a little bit more interesting. I have 5 financial securities, 1, 2, 3, 4, and 5, and the question I want to answer is which one of these should I pick? So from an analysis point of view, we've now moved beyond determining or answering the what is it worth question to the which one of these is relatively better question. Now within the investment question, I think you are obviously looking for, so one part is comparison. One part is analysis, and when we talk about analysis, your focus is on under a range of scenarios going from 1, 2, 3, 4, and 5, how would security A, security B, or even security C perform? So the analysis question primarily focuses on, given a range of scenarios 1, 2, 3, 4, and 5, and a range of securities A, B, and C, how well do A, B, and C perform when the market, let's say, is in scenario 1, or 2, or 3, or 4, or 5. So we will use the retail space financial model to answer the investment question, where what we'll try and do is we'll take a financial model and work it through the different steps that we need to complete when it comes to determining and analyzing the relatively better question. The third and final usage that we put models to on a regular basis is the funding question. And the funding question is, I've answered step 1, which is what is it worth? I've answered step 2, which is which one is better? And now I've decided that I'm going to spend or invest in either security A, B, or C, or even a combination of all three. The question that I now want to ask is, well, I'm going to go out and put $1 million into this into this investment. Should this be just $1 million of my capital, or can I possibly go out and borrow another million and invest 2 million, where half of it is my cash and half of it is money that I've borrowed from other sources? So the funding question primarily focuses on a number of different areas. A funding question is a question that gets asked in a leverage buyout model, question that gets asked in a project finance model, question that gets asked when you review an application of credit. And the primary focus in the funding question is on what is the degree of leverage we can support in our project. So three separate applications: pricing, investment, and funding. Three separate focuses: what is it worth, which one is better, and how do I fund it, finance it, or pay for it. And three separate models that we'll work with using a basic DCF approach. How do we apply that or extend that to value the what is it worth question for a cross currency swap. Which one is relatively better question, by applying fairly detailed analysis, scenario testing, model building to the retail space question, and allowing the inclusion of leverage in our model so that we can determine the impact of a series of cash flows, a series of scenarios, or and then finally determining how much leverage can we support by using and looking at the power plant case to determine what is the amount of funding and financing or debt that this project can support on an ongoing basis. In addition to the three applications that we've discussed, there are other variations that we'll see every now and then. So you can use the three models, the three variations that we've spoken about within a trading setup where the primary focus is on speed, where the primary focus is on predicting or determining where the market would be, and then using that determination to make trades. This is obviously something that is very much focused and driven by your ability to act on that information before the information is no longer useful or becomes stale. Second variation is the risk question, and the risk question focuses on again a number of many forms, but the two that are most common in our analysis and our work. The first is the value at risk question, which is, what's the worst that can happen, what's the most that you can lose in terms of the investment choices that you've made. And second, more interesting, is the limits question, which is, how do I determine I've had enough? How do I set what is enough? How do I determine how much capital do I need? How do I determine how would that capital behave under a range of different scenarios? Now, the trading question, the trading applications we have is primarily forward-looking, whereas the risk question primarily uses data to determine what history can teach us about the future that we expect to see if certain decisions are made with respect to our investment choices. So after trading in risk, the next big application that we see very frequently is the simulation application, where we could take any of the questions, the investment, the valuation, the funding, the trading, or risk applications, and primarily throw in a simulator that simply flips a switch and tells us what is the state of world our model would find itself in. We primarily use Monte Carlo simulation, and the objective on our part is to use the simulation to understand how the model, the financial security, and the decision we've made would turn out under a range of scenarios. Once again, like trading models, simulations are primarily forward-looking, but they still rely and use historical data to determine what the underlying relationship is. So quickly, very quickly, a quick review: pricing, investment, funding, trading, risk, and simulation. These are the 6 primary applications that we'd focus on, and the objective of our course today is to give you a good flavor of all 6 of these areas. And we will use the 3 cases: the CCS case, the retail space case, and the power plant and the power plant case, to give you a good idea of how these models come together. So the retail space model is primarily a DCF model. The CCS model is also a DCF model, and the power plant model is also a DCF model, right? The primary difference is that in the retail space case, we will also use Monte Carlo simulation. In the power plant case, we'll also use Monte Carlo simulation. In the retail space case, we will also use data tables to analyze how different scenarios lead to different valuations. In the power plant case, again, we would also use data tables to analyze how different scenarios lead to different valuations. In the CCS case, we will actually introduce 2 advanced concepts. We won't build those models, we'll simply introduce them, but we will use the advanced models to illustrate how models could be built in layers that build upon each other. So layer 1, layer 2, layer 3, layer 4, where each of these layers is a model in itself, and it allows us to get to a higher stage of both analysis as well as stress testing. Earlier on, we spoke about that there is an element of design in great model building. And the premise is very simple. The premise is that, look, all great products have a great element of thinking that is used to determine how this product should turn out. I think to some extent, all great models also benefit from some investment in design. And when we talk about model design, we're not talking about rocket science. All that we're talking about is, let's start with a range of objectives. These objectives determine what do we want to see when the model is finished, which then goes out and requires us to build a view of the world. Now, the view of the world basically says that, based on the objective, so let's say I want to go out and simulate oil prices, right? That's my objective. I now need to build a view of the world that basically says, what relationships am I interested in when it comes to oil? And are these relationships determining, forecasting, projecting, predicting prices going up or prices going down? That is my fundamental view of the world, right? So I take this view of the world and I go out and determine what are the drivers. So what are the drivers that will lead to prices going up and prices coming down? How do these drivers affect the cash flows of my model? So the view of the world and the drivers together used to determine how cash flows would change when both drivers and the view of the world changes. If there are any applicable rates that I use, if there are any applicable rates that have an impact on my cash flows, how would these rates change? And then finally, bringing it all together to calculate what we know as the net present value, or the NPV, with respect to a final model. So if I take this to a simple example, let's say I am primarily looking at building a model for a power plant. Now, for a power plant, there are 2 primary elements. The first is my power purchase agreement. The power purchase agreement, which allows me to sell the power that I produce to my consumers, to my buyers. But more importantly, if my power purchase agreement does not allow me to pass on the increase or decrease in fuel costs to my consumers, then modeling my fuel cost is one of the biggest, the most important, the most relevant driver of my model. Now, if you say I'm going to use fuel costs, I'm going to go out and model fuel costs, the question that I want to answer is, if I am building a power plant that uses crude oil, then what does my underlying crude oil model looks like? If I'm not building a power plant, if I'm building a business which is logistics driven and is driven by the amount the cost, the price of gasoline that's consumed by my drivers, by my vehicles, by my trucks. How does that work? And how are both numbers affected or changed or modified by changes in demand and consumption? If I'm building a model that goes out and projects the financial future of the business that I'm working with, let's say we're looking at a model for retail space. In my retail space model, my primary objective is to find out what is the store, the retail space actually worth, but I can't answer that till I go out and answer growth, both in revenue and expenses, and the impact of a range of economic drivers on my financial future. Um, if I'm looking at valuation, the primary question that I want to answer is how would financial markets respond to my business? How would financial markets value my business? And if the primary driver that I'm working with is valuation multiples, then how would these multiples change, grow, and behave over the next few years? So from a design objective point of view, if my primary driver is fuel cost, I need to figure out how would that be incorporated in my model. If my primary presentation and analysis is based on financial future of the business, I need to figure out how would that work. And if from a valuation point of view, my primary focus is on understanding how multiples would behave, then I need to figure out how to incorporate that in my model. All of this falls into design objectives. Now, effectively what you're saying is that if I go back, I'm saying I've got model objectives. I'm building a power plant. I need to figure out how oil works. For me to figure out how oil works, I need to figure out how different views of the world would have an impact on oil prices. I then need to figure out, what are the primary drivers that determine and impact my view of the world with respect to oil prices. Then I need to translate that into cash flows, translate that into interest rates, translate that into an NPV model, right? But at a higher level, I'm also saying that if I have a fuel cost model, then I need to determine what my primary assumptions are, how these assumptions would be tested, what would be the format for presenting my results, and then finally, what are my results and who are these results being presented to. So that's the fuel cost model. If I do a financial future model, again, what are the primary assumptions? How do these assumptions get tested? How do they get presented? And what are the results? What is the primary framework? What is the primary focus on results that I want to work with? And then finally, if I'm working with a multiple model, what are the multiples involved? Which ones do I want to focus on? So if I were to summarize this, what I'm basically saying is think of design as a mechanism, as a tool for identifying the data and the information that you need and the assumptions that you will use. Think of design as a mechanism for determining in advance what you would need to test. What are the expectations in terms of presentation and results? And if we have a clear idea of design, assumptions, testing, presentation, and result cycle, I think we can structure a model that can be far more effective. Now, presentation is an element that often gets ignored when we build models because a number of times we build models for ourselves. But if you spend some time again at a design stage in thinking about your primary audience, so if you're presenting to board members, the focus of your presentation is very different. If you're presenting to investors and analysts, the focus of your presentation is very, very different. For board members, you primarily go out and recommend. So I recommend scenario A over B or C, or I recommend decision A over B or C. When you present it, the focus of your presentation is on a summarized recommendation. However, you need to be prepared to defend A, B, or C with the relevant analysis, with the relevant models, with the relevant details. When you present to investors and analysts, the focus of your presentation is very, very different. With investors and analysts, you focus on results, you focus on assumptions, and you focus on data that validates, that supports those assumptions, right? So in one case, when you present to board members, the focus is on I've done the analysis, I've done the work, I've done the modeling that was required. Based on that, I think we should do A, but you also have choice B or C, and the board member may accept that at face value or dig a little deeper and ask you for more details about B, C, and A, and then go out and approve one of the recommendations that you've made. When you work with investors and analysts, you basically presenting the results both realized for the current quarter as well as your outlook for projected results over the next 12 to 18 months or so. And then their focus of questioning is very, very different. Again, depending on the audience involved, the results that you present may be valuation based on multiples, maybe financial forecast, maybe analysis, maybe relationships and linkages that drive the future of your business. And finally, if the focus of your presentation is on identifying, on presenting, on helping your audience understand in a meaningful fashion the risk associated with the security, the risk associated with the decision, the choices that you're making, your primary focus is on how values would change if different parameters change. So what would happen to this forecast if driver A goes down? What happens to this forecast if driver B goes up? What happens to this forecast if driver C does not move at all? And then, what are the linkages between these three drivers? So the focus of sensitivities is to first identify the relevant metric, the measure that you are going to use to decide how much risk exists or is associated with a given choice, and then to determine the impact of changes in these metrics, these measures, these values on the results that you're presenting to your audience. Again, the reason why we bring it out at this point is design, assumptions, testing, presentation, and results. It helps in building a model if all of this work, all of this analysis, all of this thinking is done before the model is built. Because once the model is built, changing that model, modifying that model, extending that model requires a lot more effort than including the changes that you need before the model is built on a piece of paper that you can use to drive the roadmap that you need for your model. So summarizing all of this, what we're basically saying is that great models spend a fair bit of time on design. And by design, we mean that we start off with the objective. What will this model be used for? We then determine what are the relevant views of the world that are relevant to the objectives that we want to work with. What are the drivers that affect that view of the world? What is the impact of those drivers on both cash flows? What is the relevant rates that we want to use for discounting and calculating net present values? And then at a slightly different level, again from a design point of view, what are the core assumptions? How would these assumptions need to get tested? How would we present? And what results would we be presenting? If we bring all of these elements together before we build our Excel sheets, we'll find that our work is a lot more simpler and easier. So when we talk about structuring Excel spreadsheets, we start off with assumptions. And assumptions, if we go back to the previous sheet, are directly linked to these assumptions are directly linked to our view of the world and our drivers, right? So assumptions, view of the world, drivers. So the first step in structuring our sheets is to figure out what are the primary assumptions that we need to work with and how would they change and how would their sensitivity be tracked, right? Now, once we've identified the assumptions, we go out and identify the drivers or the submodels. And again, whether we build the retail space model, the power plant model, or the CCS model, you will see that in all of these models, there are smaller submodels that feed into the primary results. We then go out and determine the primary measures that we're tracking. Now, For both the power plant as well as the retail space, the primary result that we're looking at is the financial forecast. So we want to look at how the balance sheet and the P&L grows. In the cross-currency swap model, the primary result that we're forecasting, that we're trying to work with, is fair value. How much is a cross-currency swap worth today? Linked to result is the sensitivity of those results to different submodels and the assumptions that drive those submodels. And then from a presentation point of view, we figure out what is the level, or rather at what level of detail would this model be presented. The level of detail is determined directly by your audience. When you present to board members, the level of detail is very different. When you present to investor and analysts, the level of detail is very different. When you present to your senior management team, the level of detail is very, very different. And if I were to go out and summarize this, you're basically saying that, if I were to look out sheets, I'm saying I have one sheet for assumptions. I may have a separate sheet or at least a section for drivers. I may have sheets for the submodels that drive my model. May have a master results page that goes out and gives me an overall picture of the numbers that I'm forecasting, predicting, or projecting. I may have a separate sheet or a section for stress testing, for changing these drivers and assumptions and following through with the impact of those changes in submodels and master pages. And then I may have a final sheet that I use for presenting, a sheet where I simply pick up the results and present the results without going into all the details that have been presented earlier, and yet at the same time being prepared for walking my audience through each of the 6 elements that we've described here on this specific page. So now let's apply what we've just covered to the cases that we are going to work with. If I look at the retail space case, the primary element in the retail space case is cash flows. And because I'm assuming that there is a certain amount of leverage involved in this specific instance, is debt servicing. The primary driver that I want to use is foot traffic. What is so the assumption is that retail space case, the assumption in the retail space case is that we've gone out and taken a certain amount of floor space in a large shopping center, and my two primary drivers are, as far as my model is concerned, is the amount of foot traffic that comes to that shopping center and then my share of that foot traffic at the shopping center. In the power plant model, the primary driver that we're looking at is oil prices and the impact of oil prices on valuation. Now this assumes that you may have a model where changes in prices are passed on to consumers, and you have a model where changes in prices is not passed on to the consumer. In both cases, the impact on the valuation of the power plant is quite significant. A third model that you would possibly end up building, depending on how in depth do you want to go with respect to the power plant case, is do you want to build, depending on how important changes in the fluctuation of fuel prices is to your valuation, you may want to go out and build a separate model for oil. And again, when you build a separate model for oil, you have multiple choices. One choice is to simply go out and build a fundamental model where you go out and look at economic drivers and you try and build on relationships that tell you the impact of change in one economic driver on another. For example, in the case of oil and gold, both commodities, we would look at, let's say, the change in the exchange rate of the US dollar against all the other major currencies in the world. We would look at, let's say, the outlook on inflation over the next 5 or 10 years based on what's happening in the global economy, and so on and so forth. An alternate to the fundamental model is to simply build a structural model that uses simulation to forecast prices. So both in the power plant case as well in the retail space case, there is an opportunity for us to figure out whether we want to build a submodel and we want to build a submodel for a commodity that drives our business and take it from there. What I want to do next is take some of the design principles that we've spoken about and apply them to retail space case, where we have an opportunity to go through the 4 elements that we spoke about earlier: design, assumptions, testing. Sorry, the 5 elements we spoke about earlier: design, assumptions, testing, presentation, and results. So if I look at the retail space model from a design point of view, I'm saying I have 10 to 20,000 square feet of space in a shopping center. And from a design point of view, the primary driver that I'm looking at, the first driver that I'm looking at, is foot traffic that comes into the shopping center. The next question I'm looking at is, within the foot traffic space, what is my share? What is the percentage share of the traffic that comes in the shopping center that comes into my store, right? My next question is, the traffic that comes into my store, what percentage of the traffic actually purchases something? And when they go out and buy something, what's the typical ticket size? And when they go out and buy something with a given ticket size, depending on the nature of that product, what's my margin, right? So 1, 2, 3, 4. 4 primary drivers that define my model: foot traffic, sale and purchase conversion, ticket size, rather average ticket size, and margin based on what got sold. So in terms of assumptions, I actually have a long list of items, but the 3 that I'm primarily interested in: what part of traffic comes through tourism, what part of traffic is local sales, and what part of traffic is cyclical or seasonal in nature. So, do people buy more ice cream in fall, spring, winter, or summer? Do they buy more body lotions in fall, spring, winter, or summer, and so on and so forth. From a modeling point of view, I need to figure out what are my warehouse costs. What's the amount of inventory I need to keep in store to make sure that I'm actually able to deliver an order when that order is placed. What's the ratio of my sales team to sales, and what are the additional overheads that I need to operate the store. From a testing point of view, I want to see the impact of gross margin and valuation. I want to see the impact of debt servicing, and more importantly, I want to see the impact of down cycle. What is down cycle? For me, the down cycle could be a wide variety of scenarios. So for traffic going down, conversions going down, ticket sizes going down, margins going down, all of these or a combination of these would define a down cycle for me. And then from a presentation point of view, I want to present, if I'm presenting to my investors, cash flows and valuations; if I'm presenting to my lenders and borrowers, my ability to service debt; and if I'm presenting to investors and analysts, as well as to my board members, is the impact of changes in foot traffic, conversion, ticket sizes, margin, tourism, local sales, seasonal adjustment on the valuation question. So I hope this gives you a good sense of the principle of design that we spoke about earlier, and how important, how relevant design is in building a clean, effective, and painless model. If you extend this same analysis, same approach, same design principles to the power generation model, what are the primary design drivers? The primary design drivers in the power generation model is that we're working with a combined cycle gas power plant, and what I'm primarily interested in, what is my power generation cost, and what is the peak load pricing that I can get for that power that I produce, right? From an assumption point of view, I'm interested in fuel costs, in power demand, in the peak load that I would be asked to service. At the same time, I want to find out what decisions I've made with respect to debt load, and is there or is there not an impact based on taxes, which sort of feed right back here. My optimal debt load in the case of a power plant is driven by the tax shield that generates. From a testing assumptions point of view, I want to see the impact of the above elements that we've just spoken about on gross margins valuation. And from a presentation point of view, because just like the retail space, there is a certain amount of leverage and debt involved in the specific case, I want to see the impact of all of these drivers on my cash flows, my ability to service debt, as well as any changes in these, and it's linked to the valuation question. Both the retail space and the power generation case are simple discounted cash flow models that go out and forecast projected cash flows and then determine the present value of those cash flows at time zero, and then simply sum up the series of cash flows to find out what is the project, what is the business actually worth. In the more advanced cases, you introduce the concept of contingent cash flows that are not certain. So, interest rate swap that is based on expected future interest rates. A cross-currency swap that's based on not just expected future interest rates, but also expected future exchange rates. And caps and floors that are based on actual probabilities of a given rate being realized. So, of these advanced cases, in our first financial modeling course, we are going to simply work with the structure of a model that we use to price and value a cross-currency swap. In later courses or later variation of the course, we'll actually go out and build a model for IRS and build a model for caps and floor, but that'll come later. For the purpose of the first course on financial modeling, all we want to do is introduce the concept of models that are based on expected cash flows, models that are based on contingent cash flows. So do the design principles change when you move on to more advanced products? And I think you know the answer to this question. The answer to this question is no, they don't. Again, for a cross-currency swap, it helps for us to understand what do we need. So the objective of this model from our point of view is to first answer the valuation question. How much is it worth? The valuation question is also known as the fair value question or the mark-to-market question. A second question from a design point of view is that the price that I generate from this model is known as my model price. It is not necessary, it is not guaranteed, it is not assured that the price that my model generate is the same price that the market would give me. So I need to think in terms of that if I were to go out and unwind this model, would I get the same quote or would I get a different quote? So we also need to think about the sub-model that we need for building the cross-currency swap valuation model, and this is where we'll take a quick look at what a model that forecasts zero interest rates and forward interest rate looks like. From an assumption point of view, I need data on rates, both interest and exchange rates, as well as credit spreads, as well as some indication of a relationship between them. From a testing point of view, I want to look at a handful of cross checks that allow me to see if my model is accurate or if there are any errors that have been introduced in it given the range of calculations that are involved. Finally, from a presentation point of view, I am primarily interested in both the MTM question, the unwind question, and the impact of changes in specific parameters on the value of the swap at a given point in time. So I hope that by giving you a review of the three cases and applying the primary design principles, the two cycles of design that we've spoken about for the three cases that we've just covered, you have a good sense, a good flavor of model building. So it's now time for us to go out and apply everything that we covered so far and actually go out and build a model in Excel. We'll start off first with building the retail space model, follow that by building the power plant model, and then finally wrap up this course by walking through the cross-currency swap model. This marks the end of the first session of the financial modeling course. Please go out and download the spreadsheets that came with the course. When we come back in session 2, we will use these sheets to continue our model building journey. Thank you very much for your time. This is Jawad Ahmed Fareed signing off for quants.com.